and welcome back to our session on relevant cash flows and how to appraise investments with unequal lives. In our previous sessions, we looked at the basic techniques on capital budgeting. And of course, we inputted on the points that you needed to use relevant cash flows. Now, the question is, how do we compute the relevant cash flow? So at the end of this part, students should be able to understand how to determine the relevant cash flows for the various types of capital investments they may come across, and also be able to incorporate depreciation expense for tax purposes when computing relevant cash flows. Also be able to incorporate inflation where appropriate into capital budgeting, and understand the various methods that can be used in computing operating cash flows for the appraisal purpose. And at the end of it also, we should be able to apply the equivalent annual cost approach where we have projects with unequal lives. The chapter outline will look first and foremost at the incremental and relevant cash flows and how they are computed. And then the second part will look at investments of unequal lives, where we look at the equivalent annual cost method. Now, when it comes to capital budgeting, our main focus should be on cash flows. Now, these are the points or the data points that matter, not accounting earnings. Accounting earnings could indicate profit but may not necessarily reflect that cash flows into the business. So in doing investment appraisal, the focus should be on actual cash flows and not the accounting profits or earnings recorded in the financials. Now, you should also note that we have what we call sunk costs, and they do not matter. Sunk costs intrinsically refer to costs that have already occurred and have nothing to do with the implementation or otherwise of a project. Now, for that reason, we still focus on what we call incremental cash flows. That is, cash flows that occur only when a project is undertaken. So if the cost is likely to happen or the cash flow is still going to be present, whether or not the project has been undertaken, it does not necessarily count as part of the computation for incremental cash flows. You also need to look at opportunity costs. If you have alternative uses for facilities that would feed into the new project, you need to consider the opportunity costs embedded in there and incorporate that into the appraisal process. You should also consider side effects like cannibalism and erosion, because they matter in determining how much cash flow or actual cash flow will arise as a result of implementing a particular project. And also to look at taxes. We want incremental after-tax cash flow, so taxes within the system also matter in doing investment appraisal, and so does inflation. So in general, when we are looking at cash flows and not accounting earnings, we need to ignore sunk costs because they do not matter, and incremental cash flows because that's cash flows that occurs only after the project has been implemented or as a result of the projects being implemented. You should also look at opportunity costs and side effects like cannibalism and erosion, together with taxes and inflation. Now, if you look at an expense like depreciation, depreciation is a non-cash expense. So in computing our incremental cash flow, our operating cash flows for the purposes of investment appraisal, depreciation is added back, and so we're going to see examples where we revise this and add back depreciation to arrive at our operating cash flows for the purposes of investment appraisal. Now, in generating the relevant cash flows, we also take into consideration accounting numbers. So accounting numbers are not totally useless in this case, but then we need to do a few adjustments to arrive at the relevant cash flows that we'll incorporate in the appraisal process. Now, like I said earlier, sunk costs are not relevant. Now, just because we have spent that money does not necessarily mean we should continue to spend it or that we should consider it as part of a project. So sunk costs may go into issues like feasibility studies and all. It has nothing to do with the fact that the project has been undertaken. However, opportunity costs do matter because a project has a positive NPV. It should also not necessarily mean that we should have an automatic acceptance, so that If there's a possibility of using one of the facilities for something better, if that opportunity cost is going to derail the project, then we should not necessarily proceed. We should pass on the project and move the facility to another project. Now, in also looking at the incremental cash flow issue, erosion and cannibalism are bad things in general. Now, cannibalism is usually when you see revenue inflows or cash flows for another project which are not necessarily real cash flows because they are rising because there's a demand or a drop in the demand of an existing project, meaning that this new project is typically feeding on the other project to show some kind of viability. So then in running a project, you do not need to ignore these. You need to look at erosion and cannibalism and incorporate the effects accordingly. However, if you do get synergies in the event that when you combine existing products or new projects, you get an improved outcome, then you also need to recognize the implication of that and capture that accordingly. Now, how do we estimate cash flows? Now, typically in estimating cash flows from operations, that's when we have operating cash flows, we look at that as earnings before interest and taxes, less taxes, and adding back depreciation. Now, we should also not forget salvage values, that's after tax basis, of course, to tell us how much net capital spending really went into the project. And if there are any changes in net working capital, these should be captured in, and when the project actually winds down, we need to remember to return the working capital back to chest. Now, this is an example on estimating relevant cash flow. So we have a firm that has already spent $250,000 on a test marketing assignment. But then they intend to proceed to put up a proposed factory, but the value of the factory site, which they already own anyway, is $150,000. Now, the machine to be installed is $100,000 and is going to be depreciated according to the modified accelerated cost recovery system over 5 years. Now, that is a predefined system that you can refer to in any standard finance textbook. And then there's a possibility of increase in net working capital of 10,000 USD. And of course, they have an estimate in terms of production in units by year during the 5-year life of the machine. So that's the economic life as well. Now, this is estimated as 5,000 for year 1, 8,000 for year 2, 12,000 for year 3, 10 for year 4, and by year 5, they perceive a possible decline. And so that has been estimated as 6,000 production units. Now, in the first year, they believe price is going to be $20 per unit, and the price will be increasing 2% per year after. Production cost during the first year is estimated at $10 per unit and is also estimated to increase at 10% per year thereafter. Inflation rate is 5%. Working capital, which is the initial changes due to sales, is 10,000 USD. So based on this, we proceed to incorporate the elements. Now you can see that then in year 1, the initial investment has to do with a bowling machine that will be put in place. And then that's for the initial year 0 investment, upfront investment. And then depreciation starts for the years 1 through to year 5. And we're going to have a salvage value to the tune of 21. That's the leftover value using the cost recovery framework. Now, so the third line shows the adjusted values of the machine after depreciation. Now, there's opportunity cost. Now, even though the firm owns the warehouse, they have to incorporate the opportunity cost of the warehouse, because if they had put it up, they could have made this revenue. But for the fact that they are using it, then it would seem as if they would have to rent it to themselves, and for that reason, they recognize the cost as such. Then there's an increment in working capital, so this has been captured accordingly as a change because then it has to be injected in. So the total cash flow for the investment to get the project running is 260. Now subsequently, then we have the cost framework captured all throughout for up through to year 5. Now, when it comes to the revenue side, so here we look at the things that we're going to look at in the sense that at the end of the project, the value of the land reverts, and so this is recaptured in here. And so these are the ways we come up with the total cash flows for the investments for the period. Now, here we need to estimate our sales revenue. So for years 1 through to years 5, we look at how the cash flows were generated. Recall that for the 5 years, the production in units has been given as 5,000, 8,000, 12,000, 10,000, and 6,000. So if the price during the first year is 20 and increases by 2% thereafter, then what it means is that, for example, if you take sales revenue for year 3, we're going to be producing 12,000 units captured here accordingly. We are going to see our price grow by this factor to give us a total price of this. So when we multiply, we're going to have that the product of that is this and captured here accordingly. And so that is how it's incorporated. So the first year is 5,000 times the 20 per unit. The second year is the 8,000 plus the 20 that has seen an increment of 2%, and it goes on for the years to come. So in going through, we realize that we go through the typical phase of the financial statements as a regular firm would. We adjust for sales revenue, then we look at operating costs, we look at depreciation, and then we can see from the outline the sequence for depreciation. And then we have also a case for, so once everything is done, we know that income before taxes for each year accordingly is captured for year 130 through to 30.54 for year 5. Then we incorporate taxes, and then we have net income. Now, once we do that, the next item will be to then incorporate the issue of incremental after-tax cash flows. Now, if you look closely, we need to add back depreciation. So if you look at the case where we had depreciation of 20 in year 1, which we then, if we had depreciation of 20 in year 1 and our net income is 19.8, after we add back depreciation, we arrive at the after-tax cash flows of 39.8, and that's how it goes through adjusting. And of course, the cash flows in terms of the working capital, the reductions and the increments and all are also incorporated accordingly to arrive at the final values, including the scrap values and then the reversion to chest of the other facilities that were incorporated as opportunity cost. So in total, this is what we have as a case of the first year relevant spending was 260,000 USD, and the rest follow accordingly in thousands of USD. So then, to proceed, this is what we do. We incorporate the cost of capital, which is then, once it's after tax, we also adjust for the tax component to get after tax cost of capital, and then we adjust accordingly. From this point, it appears our NPV is positive at 51,000 plus. That intrinsically means that the project is viable and should be undertaken. So that is the relevance in terms of determining your cash flows. What this presupposes is that inability to determine cash flows appropriately will influence your decision on the viability or otherwise, which could mean that you could accept projects which are not viable due to the fact that not much effort was incorporated in arriving at the relevant cash flows That could also sometimes flow from being too optimistic about sales revenue, or maybe being too pessimistic about operating costs and other relevant issues that need to be captured in determining incremental cash flows. Now, how do we address investments with unequal lives? Let's take a case of when you have the normal application rule of consider NPV to be positive and then accept, and when it's negative. But then if you do have two alternatives that have unequal life, say for example what we would call a Cadillac cleaner costing $4,000 today and has annual operating cost of $100 USD and is meant to last for 10 years. Then we have the cheapskate cleaner costing $1,000 USD today, annual operating cost of $500, and is lasting for 5 years. Now you can see that the disparities are here in terms of the initial investment, the operating costs, as well as the economic life of the two facilities. So if you have two such alternatives to choose from, the question is, how do you proceed? You can proceed by doing what we call the replacement chain. So that in this case, if we are to assume that our discount rate or our cost of capital is 10%, question is, which one are we to choose? Normally what we are then going to do is to look at how these play out. If you start with the initial one, it means that we're going to have an NPV of a total cost structure of 4,614. If we were to look at the cheapskate on the initial plane, it appears that it's cheaper at 2,895. But of course, with the unequal lives and the maintenance cost implications and the initial investment, we need to revisit. So the best will be to give each one of them or to match them up such that they have the same lifespan. Now to do that, it means we are going to do, or what we say, have a replacement chain, meaning that we're going to try and replace the shorter lifespan one such that we're going to have the same lifespan as the first one. And so we're going to repeat that. Once we do that and get the replacement chain, this is what we're going to have. It means that this is the actual lifespan for the Cadillac cleaner, and then for the cheapskate, we would have to do that twice, meaning that we invest, we maintain, and in the 5th year, even as we maintain, we reacquire another one which will run for another 5 years before they match up, and each of them has a 10-year lifespan. Now once we do that, we incorporate the relevant costs in terms of discount rate, and then what we do is to arrive at what we refer to as equivalent annual cost, meaning that if we were to get the present value and spread it out over equal installments over the 10-year equal life that we have now given each of them, what do we have? Now it appears therefore that after doing that, the Cadillac, which used or appeared to be the more expensive one, now has an annual rental charge of approximately $750, whereas the cheapskate, which appeared to be cheaper, now has $763 as the annual rental charge if you were to look at it in that direction. So then it appears that the cheapskate, though cheaper, is actually more expensive when you begin to equate the lives, and that is how you can actually work out the differences to be able to select between two projects that have unequal lives and also have differentials in investment and maintenance and others. Now that brings us to the point of looking at a few issues that we need to understand. How do we determine if cash flows are relevant to the capital budgeting decision? Now that means that it's only relevant if the cash flow occurs only if the project has been embarked upon. Otherwise, it is not considered relevant. Now, other questions you could look at will be the various methods we can use in determining operating cash flows and when they are important, and whether you should use cash flows and how you should match them in the event of inflation being present. And also you should need to also understand the equivalent annual cost method and when it should be used. Thank you very much for your time. We meet in the next session.